What's up guys, welcome back to InvestingPH. Today we're diving into one of the most popular strategies in the Philippine stock market, dividend investing. So if you're looking for a way to grow your wealth while enjoying consistent income, then you've come to the right place. In this video, we're going to explore why dividend investing is hands down the best strategy you can use to make some serious money in the Philippine stock market. And by the way, it's one of the easiest ways to create passive income. All you do is buy a stock and wait for the company to give you dividends. That's it. With just the right amount of capital and a click of a button, you've already created a way to make money for yourself even without doing anything. Now, just for those who are new to investing, this happens because when you invest in stocks, not only do their prices potentially increase over time, this is what we call capital gains, but you also receive cold, hard cash directly into your brokerage account on a regular basis. Because when you invest in dividend-paying stocks, you become a part owner of these companies, and they reward you by sharing their profits with you in the form of dividends. Imagine it like having your very own personal money machine working for you tirelessly to grow your wealth. Now, here in the Philippines, I didn't just say that dividend investing is the best strategy without any proof. Of course, I have one. I always want to test what I say. Now, if you look at our market for the past 10 years, you would notice that it hasn't moved that much. In other words, if you invested at the start of 2013 and then just left your money there, then your money would have just grown a tiny bit, only 22% gain, or 2.03% annualized return. That's if you just invested in an index fund. Here is where dividend stocks have a huge advantage, especially in a sideways market. Even when its stock price doesn't move, you are still earning money consistently. To further prove my point, I made a stock portfolio consisting of 10 companies from my own dividend portfolio, assuming I invested in these companies way back in January 2013, the same as from where FMETF started, and I just left it there. I won't add any capital to it. I will just reinvest back the dividends I got every year into any of the 10 stocks. From a starting capital of less than 95,000, it would now be worth almost 280,000, a whopping 200,000 gain. This is a 10% annualized gain, and from it, 112,000 or 60% return came from my dividend income. This is a 5% annualized return from dividends alone. Imagine, I didn't add money ever since 2013. I just reinvested back all the dividends I got every year, and from dividends alone, I've already doubled my money. Excluding capital gains, dividends alone defeat the overall return you would get from investing in an index fund. Now, from the 10 dividend companies, only 2 stocks gave me a considerable amount of capital gains, which are DMC and DNL. This gives us a more accurate data since most of the companies in this portfolio haven't moved much at all, and one is even in the negative, which is FLI, but still, it gave me a 111% return. Now, I won't stop there. I also have live proof that dividend investing is constantly beating market returns here in the Philippines. But before that, this data I've shown was all made possible because of simply Wall Street. They have tons of data available for you, and the way they present it is so clear and easy to understand. They give graphs, comparisons, and explanations wherein a beginner investor could understand. They also give you updates on the stocks in your watch list from earnings release, dividends, insider buying or selling, and when the stock falls below your computed buy price. And speaking of buy price, they also have a computation for you. The best part of it, they have 2 ways they computed it, from discounted cash flow or from analysts themselves. So if you don't know how to compute it, this will definitely help you out. But a warning, only use this as a guide. You still have to do your research well to identify if the stock is really undervalued or not. And there's more. They also have a portfolio tracker that lets you assess the health of your portfolio. So if you want to try it out, they offer their basic plan forever free. And if you do sign up using my link, you get a 14-day free trial of all their platform's features. Not only that, if you avail of their paid plan using my link, you can get up to 40% discount. So what are you waiting for? Try out Simply Wall Street. Going back, my second proof of why dividend investing is the best strategy is my portfolio. Now, I started investing in July 2019, and if you look at the index back then, it's in the 8,100 level. Fast forward to the present day, it's only at 6,600, giving it a negative 18% return. The same for FMETF, which is the one I've shown a while ago. This is the only ETF here in our country. It's also down 14%. Meanwhile, for my portfolio of handpicked companies, I am up 13.70% or 247,000 pesos and 175,680 comes from dividends, which are 71% of my total return. Imagine, even while the market is down big, my portfolio consisting of 20 stocks has beaten market returns thanks to dividends. That's why for me, I am not affected even though our market has traded sideways for more than 4 years, because as I'm waiting for stocks to rise, I'm still earning money. This is one of the most compelling reasons to embrace dividend investing is the consistent income it provides. While the stock market can be volatile and share prices may fluctuate or won't move for a long time, dividend-paying stocks offer a reliable income stream. It's like having a paycheck that you can count on regardless of market conditions. Whether the market is up or down, you can rely on those regular dividend payments to provide you with a consistent cash flow. Another one is stability and growth. Dividend-paying stocks are often associated with well-established, financially sound companies. These companies have a proven track record of profitability and can weather economic storms more effectively. By investing in stable companies, you can enjoy the benefits of their growth and success. This was made clear during the pandemic. Even though stock prices plummeted hard and the economy is in shambles, some companies even paid me more dividends. That's why when doing this strategy, you need to know the companies you are investing in. Do not just invest because the yield is high. You should do your homework first, know the history of the company, if its earnings are consistently growing, and how much of their earnings are they giving away. Because we don't want a company that pays all their earnings to their shareholders, because if they did, how would they be able to finance their future growth? That's why you gotta know the company first before investing in it. And when doing this strategy, by the way, it is important for you to understand the power of Dividend Snowball. Here's where the real magic of this strategy happens. Instead of pocketing those dividend payments like most investors do, you have the option to reinvest them back into the same stock or other dividend-paying stocks. This is what I did in my first example, and the same as what I'm doing now in my portfolio. This process is like supercharging your investments. The reinvested dividends buy you more shares. As the number of shares you own increases through dividend reinvestment, the dividends you receive also grow. This means that in the next dividend payment, you will receive a larger amount of cash. With each subsequent reinvestment, your ownership in the company and the amount of dividends you receive continue to grow, creating a compounding effect. Over time, the compounding effect of the dividend snowball can have a significant impact in your investment portfolio. The more shares you accumulate through dividend reinvestment, the larger your future dividend payments become. This continuous cycle of reinvestment and compounding can lead to substantial wealth accumulation and a growing stream of passive income. Now, the dividend snowball effect is particularly powerful when combined with a long-term investment strategy. By reinvesting dividends consistently over an extended period, you allow compounding to work its magic. As the years go by, your investment portfolio can experience exponential growth, potentially surpassing the initial investment value. In the Philippine stock market, where there are many dividend-paying companies across various sectors, the potential for utilizing the dividend snowball effect is significant. By carefully selecting companies with a history of consistent dividend payments and strong growth prospects, you can maximize the compounding power of dividend reinvestment. However, it's important to note that the dividend snowball effect requires discipline and patience. It's a long-term strategy that may not yield immediate results. It requires staying committed to reinvesting dividends and allowing the compounding effect to work over an extended period. Additionally, it's crucial to monitor the performance and fundamentals of the companies in your portfolio. Ensuring the companies you invest in continue to generate reliable dividends and maintain strong financials is essential for the sustainability of the dividend snowball effect. Now lastly, to maximize this strategy well, you need to diversify properly. By diversifying your portfolio, you spread your risk across different companies and sectors. This can help protect your investments from significant losses and increase stability. In the Philippine stock market, diversification becomes even more crucial as it allows you to navigate through the unique dynamics and volatility of the market. By investing in a variety of dividend-paying stocks across different sectors, you reduce the reliance on a single company or industry. This ensures that the performance of one stock does not have an excessive impact on your overall portfolio. Proper diversification provides a cushion against potential market downturns or the underperformance of specific stocks. For example, if one sector experiences a temporary setback, like during the pandemic wherein real estate companies were hit hard, other sectors may continue to perform well and offset the losses. However, while diversification is vital, it's important to strike a balance and avoid over-diversifying. Over-diversification occurs when you have too many stocks in your portfolio to the point where the potential benefits of diversification diminish. Managing a large number of stocks can become challenging, and it may dilute your ability to thoroughly research and understand each company you invest in. Additionally, over-diversification can lead to mediocre returns. When you spread your investments too thin, it becomes challenging to capture the full potential of high-performing stocks. Your gains from successful investments may be diluted by the underperformance of other stocks, limiting your overall returns. To strike the right balance, focus on quality over quantity. Instead of trying to own every dividend-paying stock in the market, focus on a manageable number of high-quality companies with strong fundamentals and consistent dividend track records. Thoroughly research each company, analyze its financials, and understand its growth prospects. There is no exact number as to how many stocks you need to own. It is up to your capabilities on how many can you manage, analyze, and keep up over time. So with that, I hope this gives you a good idea about dividend investing and its advantages here in the Philippine stock market. And if you want to learn more about it, then you can watch these videos next. This would really help you out. Thank you and see you in the next video.